Hi, good morning, good afternoon, everyone here at Unit Masters. Welcome to Unit Masters Week 4 out of our 6 weeks journey. This week, we are looking into understanding better DeFi and other projects in the blockchain ecosystem. And we have with us today Vasily. Hi, good morning, Vasily.
Hi, good morning, everyone. Thank you. Thank you for having me.
Yeah, let me introduce Vasily real quick. He's a founder of Velvet.Capital. It's a DeFi protocol that helps people create crypto portfolios on steroids. It combines modern portfolio theory and yield farming to construct diversified portfolios with additional yield. Vasily is also a mentor of Stacks Accelerator and a number of other Web3 startups. Prior to that, he was a venture builder at Longhash Ventures in Singapore, which is one of the first Web3 native VCs, incubating and investing in blockchain and crypto startups such as Astar Network, Xanpool, and many more. Vasily was also a project leader in Boston Consulting Group in New York, launching Fintech ventures and digital products for clients in tech, wealth management, banking, insurance, private equity, and payments. So very honored to have you with us today, and even reading your biography, it seems you're an expert in many very technical terms, and hope today you can run us through the fascinating world of decentralized finance and give us the Eli 5 introduction to the different terminology. I'll keep an eye on the chat and help underscore certain concepts that you may bring. And then at the end of your talk, we'll have time for Q&A. And everybody else, as always, please write your questions into the chat so the speaker can pick them up at the end of the input session. Thanks so much. Let's get started. Stage is yours, and you should be able to share screen in case you want to.
Perfect. Awesome. Thank you so much for the intro, Yip. Yeah, great. I'm one of those people who jumped from the corporate world into blockchain, deep down into the rabbit hole. So yeah, happy to share with everyone my insights, at least what I took out of my DeFi journey. So let me share my screen real quick. Perfect. Awesome. Cool. Yeah. So we'll talk about DeFi today. I have a quick presentation here, and then we'll jump in the Q&A. But I want to make it as interactive as possible. So please put the questions in the chat as we go as well. Right. So let's start. Why DeFi? Why everyone's suddenly interested in DeFi, right? And I guess it's not because of its technical beauty, right? But because DeFi has actually grown more than 13x in the last year, right? Now, I think the total value locked, the total value stored across all the DeFi applications surpassed $250 billion, right? So you can see on the left, and I'll share kind of the link through which you can use to track the market. The total value locked is exploding. And now we see an interesting trend. Even centralized exchanges such as Binance looking into DeFi and how they can kind of pivot and use it. So Binance CEO CZ, he recently said he fully expects DeFi to actually cannibalize his crypto exchange, right? And that's one of the reasons Binance launched its own chain called BNB chain or Binance Smart Chain, right? And now they are incentivizing more and more projects to build on top of this chain, right? So now we see a lot of adoption even on top of this chain owned by Binance. Coinbase and many more centralized exchanges are now trying to figure out how they can actually use DeFi, maybe as a backend, right? Maybe how they can use their distribution network now to onboard users into DeFi. So it's a really big trend, and I think now in the past year we saw a lot of use cases and obviously impressive growth, and now everyone is trying to figure out how they can actually tap into this opportunity. So I'll start with the quick principles before we dive into more technical terms, right? So DeFi is basically just a peer-to-peer finance enabled by decentralized tech, enabled by blockchain, right? So some of the things you see on the slides and that key principles that people had in mind when they developed the first decentralized apps in finance. So first, everything is programmable, right? Everything is built on top of smart contracts. Everything can be orchestrated by a set of smart contracts. written on the blockchain, right? It's all highly automated. Right? There's very little manual in the DeFi space. Second, I think that's a very important point to understand. It's permissionless, right? So think of it as an ultimate open banking. Everyone from anywhere in the world can plug into the DeFi apps and use them. I think most importantly, everyone can build on top of it, right? So you don't need to open APIs, give special permissions. Anyone in the world can use it. It's all open. A third point is all of it is non-custodial, right? So, and that's also an important point now as we go more into kind of the regulatory space, how to actually regulate them if they don't take users' money, right? So most of the DeFi solutions, not all of them, are non-custodial. It's all governed by smart contracts, but they don't actually store your money on the enterprise account as traditional fintechs do, right? And we'll talk about it a little bit more. Then the fourth point, right? Everything is transparent, right? So unless you're trying to do some manipulations with privacy chains or Tornado trying to hide your transactions, all the transactions are actually accessible, right? And I think maybe you talked about it in previous sessions, but anyone can actually open the Ethereum Explorer, right, or BNB Chain Explorer, and see who interacted with the smart contract, right? See which addresses are interacting, what are the balances. All the information is transparent. All of the analytics can be pulled out. And finally, it's immutable, right? And again, this is one of the difference from traditional finance. There is no chargebacks, right? When the transaction came through, no one can reverse it, right? And again, it goes to the point of being non-custodial. No one actually holds your money, so no one can reverse your transaction once it's done. So those are just some of the key principles. And again, please feel free to put any questions in the chat, and I'll either try to answer as we go, or we'll just come back to it in the end. Now, going a little bit deeper, right? I think that's a very important picture to kind of try and make sure we get a little bit smarter on the tech stack of most of the DeFi projects, right? And again, this is a version that I find simpler, at least how I look at it as I build DeFi applications, right? You might find different versions on the internet. Again, it's an emergent space, so it's not going to be perfect, but at least it helps you to structure your thoughts, right? So let's start from the bottom and kind of go up. The first layer is the blockchain protocol, right? So that's the kind of foundational network that is processing and finalizing transactions according to consensus mechanism, right? And I'm sure you talked about it in previous sessions, but basically this is like the basis of your apps. I'm sure all of you know Ethereum, right? So that was the first blockchain allowing you to develop smart contracts out of this. So basically working as a decentralized computer, right? And you see now more and more chains that are emerging on this, the first consensus layer. You probably heard about Avalanche, Phantom, Solana, BNB chain that we already talked about a little bit, right? So that's basically the foundation that provides the key network protocol, right? Then the second layer is called layer 2, right? Most people, when we talk about layer 2, talk about scalability solutions for Ethereum, right? So you see there Arbitrum, Polygon, Optimism. Those are basically networks built on top of Ethereum, just to try and take some of the transactions on chain, off chain. Do it bulk and then record back on the Ethereum blockchain, right? Because as more and more people use Ethereum, network becomes more and more congested, right? People are trying to find ways how to actually speed up and scale the transaction, right? But then I would also put in this layer 2 some of the other key infrastructural elements such as oracles and off-chain computing, right? So Again, if you want to write a smart contract on the blockchain that executes certain action according to an off-chain data, right? Let's say according to temperature outside, right? You need an oracle that takes this off-chain data and records it on the blockchain. So that's where Chainlink, Bank Protocol, and others come out. And it's an integral part of any blockchain application, because you usually need more data to kind of program advanced calculations on the blockchain, right? Then there's a middle layer that most people actually forget about, but I think it's very important to understand what we have there, right? It's basically all the tech that helps developers use the underlying protocol and kind of do it easier, right? So there are a lot of development frameworks, right? So I would even put here development languages, right? Open Zeppelin, for example, is one of the most famous frameworks, right? Is basically a collection of libraries that everyone can use, instead of coding everything from scratch, right? And then there are a lot of node services, API services, queries. So that's a really kind of project. Those are really like projects focused on developers, right? Helping developers work more efficiently, right? And actually, we saw a lot of funding coming into these tools recently, right? Including very large VCs such as SoftBank. Application layer is actually what everyone thinks about when they talk about DeFi, right? So when you walk out of the session and someone asks you what DeFi is, that's actually what most of the people think, right? And this application layer, so I put there so-called DeFi primitives, right? So those are the key building blocks of DeFi that kind of comprise the basic product offering. And you see, I'll just walk through some of the main elements, right? So DEXes and liquidity providers, right? So DEX was one of the first decentralized exchange, right? DEX was one of the first use cases in the DeFi space, right? And we can talk in the Q&A about different types of DEXes. Basically, two of them are order book based and automated market makers, right? Automated market makers are gaining more and more popularity. So you probably heard about Uniswap, PancakeSwap, SushiSwap. It's all DEXes. It's all automated market makers that now getting increasing amounts of volumes. Then the second one of the main use cases, was credit and lending, right? So you probably heard about Compound, you probably heard about Aave, you probably heard about Venus. So those are initially, they offer, I think up until today, right? They offer over collateralized loans, right? So in order to take a loan of $100, you need to put down a collateral of, let's say, $200 worth of Bitcoin, right? So it's a very limited use case, but it's very useful. One of the reasons is tax optimization, right? You live in the US or Europe as well, right? You don't want to trigger a taxable event. You don't want to sell your Bitcoin. You just put it as a collateral, right? Think of it same as security-backed lending, right? Very similar. Now, another use case is stable coins. Of course, everyone heard about it. Some stable coins that are based on underlying algorithms, right? Rather than fully collateralized, right? We call them algorithmic stable coins. This is also again one of the DeFi apps, right? Because it's basically programmed to track the price of the underlying asset without actually being fully collateralized, right? And then more and more use cases are emerging. There are insurance companies on chain, right? Mostly focused on insurance. cybersecurity risks, right? From contract exploitation, Nexus Mutual cover. There are derivatives now. Lots of projects trying to build, more and more complex financial products, prediction markets, asset management. Those are like the main DeFi apps that everyone's talking about. We can dive into more details as we go. And then there's a top layer that's recently emerging, which is basically an aggregation layer, right? So how do we actually take all of this good stuff that's being developed on the application layer and expose it to the user, making sure that we can, for example, combine different financial primitives, right? So I actually started on the right side. There's demand side aggregators, very easy to understand, right? We have now more than 40 different decentralized exchanges. Why don't we take and aggregate liquidity across them and create a 1 inch, right, which is a decentralized exchange aggregator, so that when you make a trade, the smart routing actually finds the best way to execute your trade across different exchanges, so that you get the best price, you get the lowest slippage, etc. Right? And then there's supply side aggregators, mostly focused on yield optimization. How do you actually help user find the best investment, right, or the best yield strategy across different apps, right? And that's we think that Velvet.Capital actually would go there as well, right? And I'll talk a little bit more about this example, right? Because it's basically taking liquidity from different exchanges, right? Constructing portfolio of a diversified portfolio of different assets, right? And then trying to optimize the yield across those assets, right? So then I'll just give it as a quick example, right? How we're building it across the stack, right? So again, what we're doing, and you mentioned, we combine portfolio theory with yield farming, right? So we make sure that people don't just put all their money into one yield farm and then lose them because the token goes down, right? We actually want to create a diversified portfolio, almost like an index, right? Could be an index of top coins, think of it almost like an S&P 500, could be thematic portfolios. And then we find the best way to earn additional yield from yield farming, right? From putting those assets into staking pools, lending protocols, liquidity pools, right? So if you think of it, and if I go back here, right, we're basically using everything across this stack, right? So we're building. Initially, we started on the BNB chain, right? So that's the L1. We obviously using oracles to get data on the coin prices, on the market capitalization, on any other parameters we want to use in the portfolio construction, right? Development team is using wide range of different development frameworks. So they're building on Solidity, that's the language, right? They're using Truffle, they're using Open Zeppelin libraries, they're using all this good middleware stuff, right? We're using decentralized exchanges, and we're actually using aggregator 1 inch to make sure that all of our trades get executed with the best price and minimum slippage, right? We're using credit and lending protocols to allocate some of the assets to lend them out for additional interest, right? We are considering using insurance to kind of make sure that we protect ourselves from exploits, right? We might use derivatives in the future. We obviously use stable coins. So think of it, and the reason why I got back here now, this approach to product development, a lot of people call it Lego, right? So what you do, because again, going to one of the principles of everything being permissionless and open, you take this stack and you can kind of build whatever you want from this stack, almost like a Lego blocks, right? So that's a new, I think, open banking on steroids. And then I
Maybe
see
Vasily, just going back to one slide before, I think it's worth spending a few minutes just on explaining portfolio theory in itself and what are the main thoughts behind portfolio theory so that we can then understand why the yield farming or the way you do yield farming is actually an optimized way to do that.
Oh yeah, for sure. You can come back here. I'm always happy to talk more about Velvet.Capital. Yeah. So the basis of portfolio theory is risk diversification, right? And it's especially important in the crypto world, right? Is you have a very the projects are very volatile, right? So unless you create a portfolio of different assets, right, so that you kind of diversify away systematic risk, you have a very you have a very high exposure to one coin, for example. So one of the examples, Mark Cuban, for those who don't know, is one of the most one of the famous angel investors, right? Is very interested in the blockchain. He was actually bragging that he became a DeFi liquidity provider. He put $50,000 into liquidity pool with Titan coin. He was telling everyone it gives them 200% yield, right? But then one day the token just went down to zero, and guess what? 200% on zero is still zero, right? So the one way to avoid that is to make sure you actually have a diversified portfolio, right? And you construct it not trying to chase the highest yield, but first of all, try to diversify the underlying asset risk, right? And only then, once you have this portfolio, we kind of help allocate it across different yield farming, right? And that's where the algorithm comes in, right? So basically, we look at different aggregation solutions, we look at different lending solutions, we look at different DEXes, and we find the best way to get the additional interest, right, across those. So then you have both, right? You have token appreciation on the left, right, and actually in a diversified manner, betting, let's say, on the market, right, or on the market segment, right, and then you have this additional yield from across different DeFi solutions, right? So that's
And
basic.
then maybe we can speak about these three different ways for yield farming: staking pools, lending protocols, liquidity pools. They all generate yields for people who hold assets, but in which way do the different underlying business models look like?
Yeah. So let's actually start from the bottom, right? Let's start with the liquidity pools, right? Because we talked about exchanges, and one type of exchange is automated market maker, right? And that's kind of the most popular, right? So to make sure it works, and let me see if I might have actually a slide explaining it a little bit better, right? So this the type of exchanges I talked about, right? The automated market makers on the right is kind of one of the most kind of popular ways in the DeFi space. And how it works, actually, you have a pool. So if you look at the left here, right, you have a pool of assets. Initially, it's structured as pairs of assets, right? So let's say you want to exchange DAI, which is a stable coin, basically USD pegged crypto, with Ethereum, right? So when the user comes in, there is a pool of DAO and Ethereum, right? That liquidity providers put there. And when the user comes in, they exchange, for example, one DAI for whatever 0.1 Ethereum, right? And as a liquidity provider, you basically get a fee from this transaction, right? So that's how you earn interest. There is an automated algorithm. So again, there is no order book. There's no, they're not trying to match your order like the buyer's order with seller order, right? There's an automated algorithm that looks at the quantity of tokens in the contract, right? And finds the execution price. So whenever, if 100 people if 100 people come in, try to exchange DAI for Ethereum, then the number of DAI goes up, the number of Ethereum tokens go down, so that the exchange price moves. And then, so think of it as the scale is off the balance. And now the arbitrage traders come in, and they realize that the price on this decentralized exchange is actually different from the market price, so they can make money. They come, they execute trades in the other direction, right? They earn kind of arbitrage profits because they do the exchange here, and let's say they sell it on the centralized exchange until the price difference becomes zero, right? And basically the price comes back in the balance, right? So we can go deeper in the Q&A, but that's kind of the basic principles how it works. Again, go into this slide, right, and looking at the liquidity pools. You earn interest because you provide liquidity to these decentralized exchanges, to these automated market makers protocols. How you earn money, you get percentage of the fees, right? So whenever someone exchanges money using your liquidity pool, you get the fee. You get a percentage of the fee that they pay. Now, lending protocols, right? The second from the bottom is even simpler, right? You just think of it as a peer-to-peer lending, right? You put your funds for someone to borrow them, right? Because it's over collateralized, the default risk is basically, very minimal. It's negligent, right? So basically, your funds are used to give loans to other people, right? And you basically earn the percentage minus some fees that the protocol takes, right? So it's just peer-to-peer lending on blockchain, nothing new here, right? And then staking pools, that's a little bit different because we have now, initially staking was a way to secure the network. So again, going back to the layer ones, layer twos, some of the protocols are proof of work like Bitcoin and Ethereum. So there are miners to actually solve mathematical equation to mine new coins, so to validate transactions, right? New networks are moving into the proof of stake, right? So to validate transactions, you need to actually put your funds, your share of the funds, as a stake, right? And then if you do any malicious actions, the stake would be slashed and basically taken away from you. So that's your incentive to validate the transactions, to make sure you kind of preserve the correct flow of transactions. But now more and more protocols are using staking more as a almost like a reward management, right? So let's say I'm a decentralized exchange, right? And I want to reward my token holders. So I create a staking mechanism and I say, if you stake the tokens, we can also use it as a security for the network, right? So if someone hacks it, maybe we'll take some of your funds, right? So that's the risk. But in exchange of this risk, we will give you, 10% return on the token, right? And this 10% is generated not by the transactions, but actually just, given you away part of the rewards, right? Think of it as loyalty points almost. And also making sure that you don't sell your stake, right? Because as long as you're earning additional interest, again, you have additional incentives to hold. So that's why staking is a little bit more complicated animal right now, because people call staking everything now, right? And everything that the protocols give you, where protocols give you ability to actually earn additional interest on your token, cool. Any other questions in the chat I should cover? I have one more slide I want to talk about that's more on the future, right? On some of the trends we see. Any other questions before we go there?
Yeah, maybe let's just speak quickly about lending protocols, because you already mentioned typically at this very moment in the industry, when we lend out, we are expected to have when we take a loan, we actually expect to have over collateralization. But
Yeah.
then why do people take a loan if they have to lock up assets? What's your kind of experience in the market?
Yeah, so I mean, again, it's very simple. One of the reasons I already mentioned, right? And it's especially relevant in the U.S. and in states with high taxes, such as California and New York, right? So let's say you have Bitcoin worth of $1 million, right? If you sell it, it's a taxable event, and you'll pay, depending on how long you actually hold it, right? If you hold it less than a year, then you might pay, up to 40 maybe percent even. Depends on your income, right? But I mean, you have $1 million in Bitcoin, you want to buy a nice car, and you don't want to pay taxes. So you just take a loan, you put your 1 million Bitcoin as a collateral, and you take $100,000 loan, right? You buy a nice car, and then because it's hugely over collateralized, there's a very low risk that obviously if Bitcoin goes down 10x, there is an automated liquidation of your collateral. That is treated as a taxable event, right? So then you kind of screwed, right? But as long as your Bitcoin grows, and maybe actually the price, everyone's betting that it's going to grow, so maybe the price actually grows and your collateral turns from 1 million to 1 million and 100K, then you actually sell part of the collateral and cover the kind of initial loan. I mean, that might also actually be taxable. So don't quote me on that. So that's kind of one of the use case, right? Another use case is leveraging your position, right? So let's say you want to bet, on Bitcoin, and you want to do, 2x leverage. One of the ways to do it without synthetic assets is put your Bitcoin as a collateral, take USDT loan, and then convert this USDT again into Bitcoin, right? And you can actually do it, and then put again as a collateral, take a little bit more USDT, put it again as a collateral until your kind of leverage level gets to like 2x. And that's actually, again, how some of the aggregation protocols work, right? So some of them offer you leveraged positions without actually using synthetic assets. So that's how they do it. Yeah, Roland, I think we have a question here from Roland.
Thank you. Yeah, so I was going to ask you regarding if a company hold Bitcoin or cryptocurrencies in their balance sheet, will they be able to collateralize it and loan against it tax-free as well? Do you have any information on that, on how it works on a B2B and the company level? Thank you.
Yes, I think it's more a question of the corporate policies, right? Can they do it? Of course they can. Going back to one of the DeFi principles, is permissionless, so everyone can use it. It doesn't matter, right? Do they do it actually? Probably, but maybe not directly with the DeFi, right? Because usually when companies buy crypto on their balance sheet, they use kind of one of the custodian solutions, right? So BitGo, for example, is one of the large custodian solutions used by many institutions, right? So you actually don't hold your keys. You put them in the custody with BitGo or any of the big guys, and then maybe you install some institutional version of the wallet that is connected to custody, right? So in this case, yes, they might do. And I think that actually goes back to an interesting question of treasury management, right? I spoke to a CFO of one of the crypto exchange, right? So they actually have crypto component in their treasury, and it's because part of their revenue comes in the form of crypto, right? Obviously, they have part of the treasury in crypto, and then question becomes how they actually manage this treasury. Part of it is in stable coins, and yes, they do lend. They sometimes do one of these three things with the stable coins to get additional yield. Right? Part of it is in crypto, right? So then again, the question becomes how you manage. But yeah, short answer, institutions are looking into it, right? They can do it.
Amazing. And then we have a question from Bernhard in the chat.
Yeah.
Makes me very happy because we always ask our students to think about how the speakers and their business models generate revenue for their communities. And Bernhard is asking how much handling fee or anything else can one expect from Velvet.Capital? Or in other words, how do you actually earn?
Yeah, no, great question, and that's obviously what every project should think about to kind of be sustainable in space, right? Now we are basically charging a percentage of the assets under management, right? And it's shared with the portfolio methodologists, right? So some portfolios in the future we'll probably create ourselves, right? Some portfolios are created by our users, right? So whoever wants to use the portfolio is going to pay percentage of the assets under management, right? So that's kind of the main funnel how we make money, right? But obviously there are additional revenue channels, revenue streams that we're looking at, right? One of it is actually doing taking a percentage of fiat to crypto conversions, right? So we're integrating with several partners such as MoonPay, Xanpool, and others to make sure that actually make it easy for people who don't already have crypto to actually convert from their fiat currencies to crypto, right? So obviously partners share some of the fees that they're charging with us, right? And then some of the other thing that we're thinking about is partnering with traditional asset managers and institutions, right? So almost providing DeFi as a service, right? So then the model becomes for them, again, either percentage of assets under management or subscription fees. That's already a little bit individual, depending on what we can negotiate with them.
Beautiful.
But yeah. If you have other ideas for revenue streams, please put them in the chat.
Okay, cool. Then I guess we can listen to the way forward or the outlook.
All right. Yeah, let's talk about that. And again, it's not an investment advice, right? So I'm not guaranteeing that any of this will become the future Ethereum, right, or future Facebook. But these are more of the themes that we as a DeFi community see that we actually need someone to build, and that some of the gaps that we see right now. So first one is cross-chain interoperability, right? So again, I mentioned on the layer one, more and more chains are actually emerging. Everything used to be on Ethereum a year or year and a half ago, right? So Ethereum dominance was around 95%. If you look at the PVL, 95% of all the DeFi was built on Ethereum, right? All the funds are locked on the Ethereum smart contracts. Now it's dropped down to 50%, right? So the space becoming more and more fragmented. So we need solutions to kind of make sure that we can work across multiple chains, right? And for now, most of the people actually use centralized exchanges to jump from one chain to another, right? So you put your BNB into Binance, you exchange it there on Ethereum, and then you pick up Ethereum. But everyone's looking for some cross-chain solutions on chain, right? And one of the solutions is bridges, but I think you've heard, Wormhole, and a couple of other bridges. They became honeypots for hackers, right? Because it's quite new concept and being exploded recently. Well, so we really need reliable cross-chain solution. The second one, so I touched a little bit this DeFi as a service concept, right? But that's basically how do we build compliant institutional DeFi, right? How do we merge CeFi with DeFi? And I think there are two kind of contrarian points, right? One point of view is that, and that was kind of initially once DeFi emerged, one point of view is it's all anarchy, right? We don't need centralized institutions. It's all going to be governed by people and DAOs and all that. There's no going to be interface with any traditional financial services. But the other point of view is, very fair. All the traditional financial institutions already have wide distribution networks, right? So why don't we use those distribution networks to actually bring DeFi and crypto to mainstream users, right? So I'm kind of more leaning towards the second one, and trying to figure out what is this institutional DeFi and how it's gonna move forward, right? Under collateralized lending, that's an obvious one, right? There are some use cases why you would actually want to take out loan that is kind of smaller than the collateral you put in, but everyone wants under collateralized lending. So trying to figure out how to actually score clients without knowing who they are, right? Because that's the main premise of DeFi. But maybe looking at some transactions on the wallet or some of the other interactions. Then real world assets, that's an interesting one. Everyone's been talking about it as long as I can remember, right? So if you play some recording from 2017, everyone was talking about tokenizing real estate, stocks, anything, you name it, all the assets. But I personally haven't seen good and widely popular use cases there. So I think we're gonna see more and more of this, and we actually need. And I know a couple of projects that are trying to do it with real estate. I think the complexity there is in regulation as well, right? So how do you actually make sure that regulators will recognize your tokens as actually legal proof of ownership or whatnot, right? UX layer is the second from the bottom here. That's more on the mainstream adoption, right? So yes, DeFi exploded, right? And it's grown a lot, but we're still far from the mainstream adoption, right? And it's mostly catering to kind of very technical users right now. I don't know if any of you actually personally use DeFi protocols, right? Decentralized exchanges and lending, but like actually, trying to figure out how do we take all of this good tech that we talked about, all of these different layers, and wrap it into a very simple and easy to use app, right? What's the user experience? It's another question that everyone's trying to solve. And then the last one, and I think you'll hear a lot about it, especially now with all this Metaverse hype, right? How do you actually create financial services in this new digital economy, right? And there are lots of buzzwords: MetaFi, GameFi, SocialFi, right? What are some of the innovative financial products, innovative financial solutions that can be created? So one of the examples that we see now is using your NFT as a collateral, right? So let's say you play a game, you have your, sword as an NFT, right? You want to put it as collateral and take a loan against it. So yeah, those are some of the topics that I personally, and I hear from the community. Maybe there are some more, right? Feel free to put it in the chat if you heard anything yourself. Always interested in learning more. But yeah, that's what I want to talk about today. Thank you again for having me. I'll open the floor to the questions, and I see one hand already from Rasha Fon.
Yeah, that's me. You can call me Sunny. Yeah. So I was listening to this presentation the entire time, and I've obviously been involved in crypto for some time, but it, like when you said DeFi is built, it seems like it's catered specifically to very technical people. I think that's true because despite being involved, I still don't seem to understand it completely until I listen to you today. But for a beginner starting out, what would you recommend are easy lending protocols or staking pools where we could use, and what are the main risks? Would you say is it that is it the main risk that if you go on a lending protocol and obviously the price falls, you lose your initial investment, or can you talk a little bit about that? Thanks.
Yeah, sure. No, great question, and I think it's the right question, right? Because the best way to learn is actually try it yourself, right? I personally suggest folks using some of the apps on the BNB chain. That's because they have a very easy on-ramp, right? So if you have a Binance account, you can basically transfer your funds straight to your, wallet on the BNB chain, right? They make it very easy. And that's why I think BNB chain now is #1 by weekly active users, even surpassing Ethereum, right? Another advantage is that the fees are much lower, right? So you don't need to spend like hundreds of dollars to interact with content, right? So in the BNB chain ecosystem, PancakeSwap is a very popular exchange that you can try out, right? So you can actually take some BNB, go to the PancakeSwap, and try to exchange your BNB into I don't know, wrapped Ethereum, for example, or any other token. Just see how it works. Just play with it, right? You can also be a liquidity provider on this PancakeSwap, right? So you can supply your pair of assets, right, as a liquidity pool to earn additional interest, right? So you can supply, I don't know, BNB and wrap Bitcoin, for example, right? Again, just play with it, see how it works. The credit and lending, again, in the BNB ecosystem, Venus is a really good one. That's basically, again, lending protocol. You're not gonna lose your stake if you just put it for other people to borrow, right? So again, as I mentioned, because it's all over collateralized, there is like negligible default risk, right? So you don't have risk that people actually don't give you back your money, right? One of the risks is that just the price of the token that you put down as a collateral will go down, right? But if you don't take yourself, if you don't take loan, if you don't take a loan yourself against this position, then no one's gonna take the fund. So yeah, go there, try to play with it a little bit. Don't use huge amounts in the beginning, right? I think BNB is a good kind of sandbox because it doesn't have high fees, right? And then once you feel confident, you can use Ethereum or you can stay in the BNB system, right? You mentioned risks, right? So again, there are some risks of the product itself. So again, right, if you take a loan and the price of the token goes down, it can trigger liquidation, right? In the liquidity pool provider, kind of liquidity pool provision, there's a thing called impermanent loss. So let's say you're providing liquidity of Bitcoin and Ethereum, but then the price of Bitcoin goes 10 times up and the price of Ethereum goes 10 times down, right? Very unlikely, probably in the current situation, but let's imagine, right? Because it's a liquidity pool, most of the exchanges demand that, again, if we kind of come back here, right, you will need more or less equal parts of the tokens that you provide in a liquidity pool. So it will effectively trade your kind of Bitcoin that is now much higher in the price into Ethereum that is much lower in the price. So theoretically, you would lose potential profit if you compare it to just having Ethereum and Bitcoin in your wallet, right? But again, if the prices move back to the normal level, then then you basically go back to your initial state. So that's why this loss is called impermanent, right? But you can read a little bit more about it. And then another type of risk is the smart contract risk itself, right? So we one of the reasons people move into DeFi is because theoretically it should be more secure, right? There is no centralized party, but because it's very new, hackers actually find ways to kind of find vulnerabilities in the smart contracts. So always look at whatever project you use, try to make sure that it's being audited, right? There is a process called security audit where projects ask an outside firm to do an audit, right? And there are a couple of couple of large firms that are doing it, right? So try to make sure that it's audited. That will not eliminate the risk, right? But it will at least decrease it, right? And make that it's not a scam, at least. All right, I see one more question from Wena Young.
Yes. Hi, Vasily. Thank you very much for your very insightful presentation. I also read that you had a very impressive personal, professional path coming from BCG and now in blockchain. I work for the World Bank Group, and it is a very traditional and also finance related field. And I'm also interested in blockchain and DeFi, especially social fi, this movement. And I would like to get more involved. And this course is really fantastic. It helps me to understand more. But I'm interested to hear from you how you moved from consulting to now working at Velvet.Capital, and what suggestions you have for people in traditional finance, and what are the ways that you see best for us to leverage our existing financial skills, understanding of the economics, markets. Thank you.
Yeah, look, great question. Again, I would kind of go back to my first recommendation. You need to start actually using those DeFi protocols, right, to understand how they work, but also to get involved in the communities, right? Because another thing that we haven't talked about today, but I'm sure you'll talk in your other sessions, is that because products are most products, even in the DeFi space, are managed by the community, right? There are a lot of DAOs. So once you actually start using the product, or even before using the product, you can check out the community. You can go to the Discord. You can ask questions there. People are actually surprisingly helpful. You know, everyone is answering questions, so you can learn more this way, right? And then you can also learn about any open positions for like contributors. And it shouldn't be like it could be part-time at the beginning, right? So for example, if it's a DAO working on some lending protocol, right? And they may be looking for someone to create a new product, right? Maybe you can kind of help them with your knowledge, right? Part-time at first, and then you start getting the experience, and then trying to find new roles in the space. And again, when I look at the space, I would kind of categorize it into more centralized companies, such as exchanges, Coinbase, Binance, custodians. I would also put them there. Maybe some like analytics solutions, and then decentralized. So I think jump to the centralized one could be another option, as it's easier. Usually they have similar positions to traditional finance, and then gradually moving into DeFi, either together with the company or personally. But yeah, I think my personal path was I personally started using crypto back in the days, and then I was always kind of passionate about it myself. I was having myself some challenges. How do I manage my portfolio, right? That's one of the reasons why we founded Velvet.Capital, to kind of make it easy for people who don't have necessarily enough time, right? Because they work in consulting or not, right? But they want an easy to use solution to get exposure to crypto, right? And then I joined a VC firm, an accelerator, right? I kind of then was in several communities, again learning, etc. And yeah, finally made the jump to full time. Everyone has its own path.
Well, very inspirational path, and looking forward to seeing the next evolution of Velvet.Capital. They have a Discord channel. You can find Vasily on LinkedIn. It was in our email that we mailed out to all of you. And hopefully see you all again on Thursday, where we follow up on what Vasily already looked into, the Metaverse and UX, UI improvements with Bettina, who brings a lot of experience in building products in the design space for the crypto community. So thank you all very much for being with us today. And thank you, Vasily, for sharing your knowledge in very understandable way. You know, it's so tough sometimes to break down all of these topics into composable or digestible blocks. You did so well with the Lego blocks. Thanks so much. And everyone else, I hope you kind of navigate and look back into the 1, 2, 3, we kind of looked into the basic principles, and now you're at a level where you can understand application specific Lego blocks. And then at the end of the course, hopefully you are able to navigate the entire blockchain ecosystem and find your own niche in which you want to contribute, become a builder, become an investor, anything else. See you again on Wednesday for crypto coaching tomorrow, or on Thursday for the next speaker session. Bye-bye.
Thank you, everyone. Thank you for having me. Feel free to connect on all the social media. All right. Thank you.